text for you.
I'm better.
So when I was running also today, I would just like control F like the buzzword.
Oh, I would do that too.
This mod AI is good. Not the actual fucking.
I totally agree. Yeah.
Everybody's ready for the midterm, right? Wednesday here in this room. Just for the record, we do have class following Monday on the 2nd, regular class. Okay, just not indication of that. And then we are off on spring break. Okay, so this is a cross-listed course. We do not start again until the 16th. Everybody on board with that? This class, midterm, then class a week from today, off to spring break back to Monday the 16th. Okay. All right. Any questions on the midterm?
Do we have class next Wednesday?
No. Everybody's crystal clear on all the materials. Focus on the slides, the examples, be able to work through the examples. Remember, it's not a memorization exercise, it is a learning exercise, so understand what are the facts that are important. And when you're going through my examples, hone in on the facts. Don't immediately start solving the problem. What is the question? What facts bear upon that question? If they're extra facts, not every fact bears on the question.
Will you be given like depreciation gains?
Yeah, I gave you all the depreciation schedules that you will need. I will give you calculators, simple calculators, and that's it, second one-page notes. The way I view the notes is from a business perspective. You're going into a meeting. These are things I just don't want to memorize. It happens, but it's not an exercise of how small you can write. Against the eyesight is amazing. All right, well, just shoot me a note over the next day or so if you have any questions on it. Okay? All right, so today we're going to continue our journey on book tax differences, and we're right in the middle of it. So we're going to talk about net operating losses. Hopefully the technology is squared away. It was a little choppy last hour. So one area where we can have book tax differences is net operating losses. And by definition, you have book tax differences when you have a net operating loss. From a tax perspective, this is to ease the tax burden of the tax year, right? We've said the tax year can be 12 months. It cannot be greater than 12 months. File the tax return in 12 months, right? And for corporations, it can move because it doesn't have to be calendar, but it has to be 12 months. So if you have more expenses in that 12-month period than you have income, for tax purposes, if we didn't have net operating losses and the carryover and carry back rules, you don't get any benefit for that because there's no taxable income. So this is try to provide some leeway for taxpayers to have a multi-year determination of what your profitability is. And so when I do have expenses greater than income, that is called a net operating loss. Everybody calls them NOLs. And I am allowed to, in a tax year, to carry over that loss to another tax year to reduce taxable income in that future year. Carry back year or carry forward year. Okay? So effectively what it happens is if I'm in a carry back potential, I amend that prior tax return, put that loss on that return, it offsets income. I paid more tax because my taxable income was higher in that year. That amended tax return will trigger a refund from the IRS. If it's a carry forward, which I'm in that period now, then I get to put that loss on a future year's tax return that had income, lowering that income, paying less tax. So this is a grace of the government to allow me to move that loss amongst different tax years, otherwise I'd be stuck in that particular year. So let's think about, we got to put our accounting hat on and our tax hat on. What happens for book purposes when I have a loss? It's just a loss. You start talking to an accountant about moving that loss to another year, they'll be like, what are you talking about? That's 2025's loss. That just is what it is. So there is no ability from an accounting perspective to shift it amongst accounting periods. Okay? We just talked about tax, we do. Okay, and it depends on the year the loss was generated, because just like I was saying, depreciation is a common area where the government always gets in there and tries to influence taxpayers. They also, the NOL area, they always are tweaking the NOL rules, basically due to misogynist events that happen in the economy. Think of the pandemic, right? That was a classic one. 2020, when the pandemic hit, we all stayed home, nobody did anything, and revenues went way down for companies, right? So the government's like, okay, I know what happened. I had taxpayers who paid tax previously. I'm going to set up a temporary carry back potential where they can get some of that previously taxed income back as a refund. That doesn't exist for both, right? Pandemic 2020, people just had losses. Just chalk it up. So what happens when I do utilize an NOL, meaning that I found a carry back or a carry forward year that offsets that. So when I recognize an NOL, I have an unfavorable temporary book tax difference in the year they generate the NOL. Why? Because it's of no use to me in the current year. Right? I have a loss, but it's not deductible. There's no income. Right? And then the year in which the NOL is utilized, which it offsets taxable income, carrying it back, if I'm in that particular time window, or carrying forward, which is where we are now, and it offsets taxable income, then I get a favorable temporary book tax difference, right? Because I'm offsetting book income and arriving at taxable income. That's a favorable because I'm paying less tax, and it's temporary because there is no time limit on utilizing my NOLs. There's an indefinite carry forward. Okay, so the utilization of the NOL for tax purposes depends on the tax year the NOL was created or originated. What year did it happen? If it happened after 2017, which is what I really want you to understand, there is no carry back potential allowed. So we used to have carry back rules, but they've stopped allowing carry backs. And we can carry forward, and we can do so indefinitely, which means forever. Okay, so I can go forward forever, which is a good thing, because I'm never going to use that, lose that loss by the passage of time. But I only get to offset 80% of the taxable income in that future year. So the government wants to collect some, so it's kind of a compromise. I want to collect some tax in that future year, but I allow you to offset at least 80%. Well, and the taxable income. Okay. Okay, let's do 5.9. Anthony,
In 2025, PCC reported taxable income of $250,000 before the NOL deduction. Assume the PCC has the NOL carryover from 2024. What is PCC's 2025 taxable income and its NOL carryover to 2026? So if we do the 250,000 minus the 200,000, left with 50,000 of taxable income, with $100,000 NOL carryover to 26. The carryover can be carried indefinitely, and they can deduct. Sorry, excuse me. They can deduct.
You need my water?
No, I'm all right. Thank you. They can deduct the 2024 NOL carryover against 80% of the 25 taxable income for the NOL deduction of $200,000.
So I think that the answer verbiage is a little jumbled, but basically you get offset 80% of the 250,000 in the current year. Any amount of NOL that is not offset, it just keeps carrying forward. So you never lose it, it's just waiting for a year that it's less than 80% taxable.
And now let's assume $300,000 NOL originated in 2017, and PCC broke even each year from 2018 through 2024. What are PCC's 2025 taxable income and NOL carryover to 2026? So it's going to be $0 of taxable income because it's going to net out 250 minus 250 with a $50,000 NOL carryover to 2026. Because they can deduct 100% of the
operator losses.
Yeah, so I failed to mention that in the prior table. So back to, if it originated before 18, then it's back to, and that can offset 100% of taxable income in that year, and it's forward only 20. So if I get the year 21, then it's what we would call expired, and then it's lost forever, right? And it can offset 100% of taxable income. So these are just the levers that the government pulls when they're enacting the rules. Can it go back, can it go forward, and then how much can it offset in those given years? And so it's always determined based on the year, the law in which the year it was created. So even though that NOL that Anthony went through was pre-17, and it's being utilized after 17, it gets to be 100% because that's the rule. That's the rule that was in place in 17.
What if you have carryover from before 2017 and after?
Great question. So you use the oldest first. So this is also the government wanting you to use as much as you can. And that would make sense because it's only carried forward for 20 years. So the government wants you to get through that and then leave your indefinite carry forward in place. Obviously have forever to use that.
What if it was able to cover 97% of the taxable income and then you still had some from after 2017 but you're only allowed to use that for 80%?
So then you would just apply them in that order. So if I'm answering your question correctly. So you apply the first and reduce as much as you can, and then you go to the next NOL that's available. So you just keep working your way through it, but it's a first in, first out. Okay, 5 to 10. Oh, yes.
Between 2017 and 2021, was there carry back? I know that, when we went through similar NOLs and.
Yeah. So there's the, I researched that as well. It's this footnote here that the authors put in. Special rules applied for NOLs incurred after 17 and before 21 that no longer apply and are beyond the scope of this text. So what that is, the key there is the before 21. That's the first year of the pandemic. That was 20. So what they had there was a 5-year carryback. So what they're saying, the reason they didn't put it in this chart, I think, is because we are now greater than 3 years away from before 21. So we can't amend that return anymore. That return is locked in. So that has already happened. So practically what we are is in the beginning and after 17. Extremely confusing. I agree with you. But this is the government. Think about the pandemic. It was extremely confusing in multiple instances. So the government was just trying to say, okay, we had people that paid taxes before 2020. We want to be able to get you back a quick refund by virtue of the world stopping from 2020. So that's why that special rule, but we kind of distance ourselves from that big tax cycle. So prospectively, if you have a loss today, no carryback, carry forward indefinitely only 80% offset in the future. This will no doubt change if we go through a recession or some other event that happens. The government will address. Okay, 510, Jared.
Assume that PCC incurred a $24,000 NOL in 2024 that it carried over to reduce 2025 taxable income from $100,000 to $76,000. What is PCC's current year book tax difference associated with its NOL carryover? Is the difference favorable or unfavorable? Is it permanent or temporary? So since the question is asking when the NOL is utilized, it would be a $24,000 favorable temporary book tax difference. The NOL carryover from the prior year is deductible for tax purposes, but not for book purposes. The NOL carryover from 2024 is fully deductible because it did not reduce 2025 taxable income by more than 80%. It reduced it by 24%.
So this is where this is a classical question that could be on an exam. So just be methodical. There's 3 things that are asked here. What's the amount? Right? That's what we got to know when it's originated and what does that mean? Is it favorable or not? We're in the year we're utilizing it. Favorable, I have my tax hat on, and something that reduces book income or lower taxable income is favorable, i.e. I pay less tax. And it's temporary because the indefinite carry forward. So the premise under the accounting rules is you will ultimately become profitable. That's kind of the mindset of the accounting rules, is that if indefinite carry forward, you will use it. That's why we keep it temporary. Although there is some companies, no doubt, that lose money on their way to going out of business, right? Because they're never going to turn around.
What about this problem would be different for it to be like an unfavorable book tax difference?
So this one would be very difficult for me to think about, because unfavorable means I pay more tax relative to book.
Okay.
And this attribute is a reduction of income, right? It's like a loss that's carrying forward. So this one would almost always be favorable.
Okay.
Because I'm gonna use it, right? I'm never gonna, it's
Right,
unlike
it's never-
depreciation, which you'll see depreciation when we cover that can be favorable or unfavorable depending on where you are in your lives.
Okay.
Yeah, you're exactly right, exactly right. Yeah, if the year, that's a great question, thank you. If in the year it's created, it's unfavorable.
Okay.
Right?
So this
Because
is
I don't have
unfavorable in
taxable income.
2024,
Yes, it's unfavorable in 24, it becomes favorable in 20.
but it's asking for their current year.
Yes.
Okay.
Yes. Okay. Thank you. Okay, moving on, out of NOL, so interest expense. Corporate interest expense deductions are limited to 30% of taxable income for interest expense, taxes, depreciation, and amortization. That definition is referred to as adjusted taxable income, or ATI, in the tax code. Everybody refers to it as effectively EBITDA. 30% of EBITDA can be deducted. If you're in my international tax course, we're going through this limitation on Wednesday. But it applies not just in the international context. They greatly expanded the interest expense limitations in the Tax Cuts and Jobs Act of 2017 and Trump 1.0. This was one of the offsets from lowering the corporate tax rate from 35 to 21. They limited interest expense. This is the skeptic in me. If you're going to lower my tax rate but limit my deductions, like, okay, they're playing budget games, playing with the spreadsheet, right? Okay, so we're talking about corporate interest expense, and so interest expense that is not currently deducted can be carried forward indefinitely for tax purposes. So we have the same concept as NOL, current NOL creation carries forward indefinitely. So what happens for book treatment? If I have interest expense on the income statement, it's a reduction, right? There's no limitation on the amount of interest expense deduction. Tax treatment can be limited to 30% of EBITDA. We have a tax difference for those taxpayers that have insufficient EBITDA or outsized interest expense. So it doesn't mean we always have it. You can have a company that doesn't have any interest expense, right? They don't have any debt. Or you can have a very highly profitable company with a low amount of debt, 30% of EBITDA is plenty of room to fully deduct the interest. It's only for those taxpayers that their fact pattern has a limitation on the interest expense. So any currently non-deductible interest expense creates an unfavorable temporary book tax difference. Same thing we talked about on the NOL just now on the year of creation. It's unfavorable because it's in my book column, but it's not going to make its way to my tax column. Can't deduct all of it. It's temporary because I get to carry it forward indefinitely. And the theory is an indefinite carry forward. I will eventually get it, and it will be equal to the same amount. Okay, the bubble here, the Tax Cuts and Jobs Act. Just FYI, broadened the types of business entities subject to the interest expense limitation and lowered the historical limitation from 50% of EBITDA to 30%. So what that effectively did was result in many more businesses facing limitations on their interest expense deduction. Not only did I broaden the applicability, I lowered the threshold. I'm capturing more taxpayers on limiting their interest expense because I use that as part of a pay for lowering the corporate tax rate from 35 to 20. Okay, this is where I was going with those columns. This is the way I like to think about this. It helps me with the favorable, unfavorable aspect. So the second column is the book income numbers. So that's, you get that from your accounting friends down the hallway. Hey, what's our income statement look like for the quarter we just finished? They're gonna give you that. You're gonna have your kind of roster of historical book tax differences that you've been tracking, right? I know I got depreciation. Remember we had that one in the well, I gotta worry about that. I gotta think about interest expense, how much was that? Was that gonna be limited? That's gonna fill in this column. Book tax differences, because I'm gonna either increase book income by taking, by putting income in or reducing an expense item that was in book and arriving at taxable income. And I'm gonna go across to taxable income. Okay? This is totally different than individual income tax for you that were in that course, right? Because we didn't have this starting point. We didn't have this column of an income statement. We had to build it. It exists here because we're dealing with corporations. Okay? Notice all these footnote references here in that column. That's effectively your work papers, right? If the audit firm wants to come in and start asking questions about your tax expense, you'd be ready to answer any question you did a book tax difference on. Now, they could ask, why didn't you have a book tax difference for cost of goods sold? I have to answer that question. So you have to answer the questions in which you do have a book tax difference and then prove a negative that I didn't have one on the other one. But if they start asking a question about why is revenue 60 million on this example, you're like, well, I'm a tax person. Talk to accountant. Right? They gave me that number. If that number's wrong, you got bigger issues. Right? So, a few takeaways about that exhibit. We start with book income in column 2, which oftentimes represents audited numbers. We got great jumping off. Right? Those numbers are wrong. I got bigger problems in my tax. Okay. Documentation would support that next column, favorable, unfavorable adjustments. Note those footnote references. Those were all to the examples we just worked through. That would be my work papers effectively. Like, well, why did I have a book tax difference on goodwill amortization for an asset acquisition? Let me go find that, and I got that. I worked that all out. Here's the differences between the book and tax and how I'm rolling those out. And you need robust documentation for those book tax differences and review, right? Everything in accounting, you have to do the report, and it's got to go through a couple sets of eyes to make sure, yep, that looks right, that makes sense, we're doing that. And you keep a running inventory of those book tax differences because you know your business and you know where you have differences with accounting and what your business does for tax purposes. I think it's helpful to occasionally, as a best practice, find a comprehensive list of possible book tax differences. You just go through them. Be able to say, why don't I have this? Well, my business might not have that, right? But it's a memory jar, right? Don't just get caught up in the fact of just filling in the ones you always have. Always take a look at it, like, why don't I have that? Why don't I have that? Make sure, because that question can come up. Okay. So that's book tax differences, right? We got permanent, temporary, favorable, unfavorable. Corporations report the components of their taxable income on Form 1120. That's the corporate tax return. See Exhibit 5.9. That's a nice, goes through all the examples and shows how all that stuff ultimately lands on the corporate tax return. But it's effectively this column, this last column on Exhibit 5.8. Okay. The Form 1120 also includes Schedules M1 and M3, depending on the size of the company measured by assets. The M3 is a little bit higher, I believe, for bigger corporations. Reporting book tax differences. What I want you to think about this is what you're reporting to the government. You don't show them this schedule. That's yours, right? You might show your audit firm that. But when the IRS comes in, they're gonna see only what you have filed, right? We have a self-reporting system, so they only see the forms that you send in. They have required you to do this as a component part of your, I think it's on page 2 of the Form 1120. So just walk you through what that is. Line 1 here is net income or loss per books. 4.117 million. That's this number here. They're saying, tell me what your book income number is. And then we work over to, here's your income that you told me, your taxable income on the tax return, page 1. All of these are the book tax differences. We work through in every one of those examples. And you'll see here, there's an attachment here because there's an other, and that's just capturing meals, bad debt, and that. So this is, and I just make the point here, this 5.66 million on line 10 on the bottom right does not equal this number. And the reason being is because there was an NOL deduction of 24,000 and a dividends received deduction of 15. Remember we talked about dividends received deductions. Now on laundry list of book tax differences. Those appear after line 28 on page 1. So there's still a reconciling difference, but the number that the government wants us to tie to is a pre-NOL, pre-DRD number. Okay, we still get benefit for those deductions in arriving at taxable income. But for some reason, they want to tie us to 28. Now, the government can ask any question on any of these book tax differences. They can ask questions about your pre-tax income, all of that, your book income. They can ask, why don't you have something on this line? Why isn't there, you see depreciation here, just by the way. So 5A is depreciation, and 8A is depreciation. Remember, depreciation can start off being favorable because I'm going to get accelerated depreciation for tax relative to book, but over time, they switch, and straight line exceeds lower depreciation, tax depreciation in future year, so it would be on different lines. So if they ask you, why don't you have something on 5A, you would say, oh, I'm in this portion of my depreciation lives, and so I have a, this is a favorable item, 700,000. And so I don't have the unfavorable portion. Depends on where I am in my life. Okay. So this is the schedule the government sees that is effectively making you report that that spreadsheet. Show me your book income, show me your differences. I know the differences because I'm a tax person, being the IRS, and I want to test you and make sure you got that correct. Okay, a couple of more areas on corporate tax compliance. Consolidated tax returns. So, an affiliated group of U.S. corporations typically elect to file a consolidated tax return. That is a single return including the results of all affiliates as if they were a single corporation. Okay? So, if I'm working on with a big U.S. multinational, they're going to have their U.S. company and they're going to have lots of U.S. subsidiaries. They may have different divisions that they separate by legal entities. They may have things that they've acquired over time that are doing different things, and they've kept those in different corporations. So all the U.S. domestic corporations greater than 80% owned are affiliates, and I can elect to file a consolidated tax return. I have never run into a company that meets those requirements that does not elect to file a consolidated tax return. Okay? And so it's 80%, it's technically voting power and value of the other corporation. The reason you see a vote and a value component, people were playing around with preferred stock. And if you had greater than 80% of vote, where you can introduce a preferred stock owner, you may own less than 80% of the value because of the preferred return. So the government tried to equate the two. So you have to, if you are 80% of vote and value, then you're allowed to be an affiliate and file a consolidated return. The big benefit is the second bullet, or second sub-bullet. Not all of my subsidiaries make profits, right? I'm I may have one that's a startup division, I may have one that's kind of mature and being replaced or being disrupted by technology. It might start to lose money. If I file a consolidated tax return, I get to automatically offset all of my income and losses. I'm filing one tax return. Remember when we started, we talked about NOLs, right? Cut off the need to have an NOL. I got an immediate use in the current year. I have one affiliate that's profitable and one affiliate that's a loss. I get to net them together in the consolidated return. I only file one tax return, including all the corporations. So by virtue of doing a single return for all affiliates, any intercompany transactions must be eliminated, and they're effectively deferred until such time as the property leaves the affiliated group. Okay, so I don't give tax effect, even though legally subsidiary A might have sold product to subsidiary B for the entire year. That has no tax effect because subsidiary A and B are consolidated group members. Right? So I have to eliminate that noise in the computation. Just like I do for accounting purposes, right? I don't count those as sales. I do a consolidated financial statement. And so it's not forgiven, it's just deferred, waiting for a transaction for the product to leave the affiliated group. Now, the tax rules for consolidated tax groups are very different from consolidated reporting for financial statement purposes. So the concept is similar. I'm going to take multiple entities and do one financial statement or do one tax return, but the mechanics of how I get there are very, very different. It is 1120. Yeah. What you do is you just list, there's an affiliation schedule, so you list all the corporations that are included in that. But the numbers are just one number, but it includes everybody's number for that line item. Same form number. There are, this is very complicated, putting the consolidated group together and making sure you unwound all the intercompany transactions. There are lots of intercompany transactions between U.S. affiliated group members, services, inventory transactions, any kind of payments between the two, all that has to be unwound. And most of the large accounting firms have subject matter experts on consolidated tax returns. The regulations are pretty extensive. This was something I never dabbled in. If I had a difficult consolidated return question, I always ran that up the flagpole at National in DC to get input from those individuals. I just never wanted to miss something in the consolidated return area. One of the best persons I dealt with in this area was an engineer of all places. He started his career as an engineer and then he went into tax. And it's like, hey, consolidated return sounds pretty cool. There's a lot of rules and a lot of complexity in that. So he just became a national expert on consolidated return regulations. Concept sounds simple, difficult in practice, but the big benefit is that offset. Instead of waiting to carry forward losses and that type of thing, I get immediate use of those losses by offsetting. Okay. So a couple other compliance aspects. Tax return due dates. Corporate returns, corporate tax returns are due the 15th day of the 4th month. Why do we have that weird language? Because I could have fiscal years, right? I could have 52, 53 week years. So I have to have this rolling 15th day of the 4th month following the end of the year. Okay, so that would be April 15th. Corporations do rarely file by April 15th. The reason being is because they get an automatic extension for 6 months. So add 6 months to April 15th, and that becomes the real April 15th in my mind is October 15th. So that's when taxpayers are filing their corporate tax returns during the fall. Right? October 15th. They really ramp up in my mind about midsummer and go through the fall. And, so one of the things we're going to talk about when we get into chapter 6 is the financial statements and tax accounting. We're making the entries for that tax return not in midsummer and fall. We have to do those in January for that year, right? Because books are going to close. Financial statements are not open for 10 months. So that's one of the stressors in busy season, problems is because you do make estimates, you make your best efforts, but it's a compressed time period than when you normally do all your work to get your tax return ready. Is there a question?
Oh, that was just my question, like, when they extend it 6 months, it's not like they're counting the stuff that happened within those 6 months, they stop at the
No,
15th.
it's all, so for a calendar year taxpayer, in 26, it will go January 1, 25 to December 31, 25, and that's 12 months.
Okay.
That will be reported by October
Oh, 15th of next year.
this year.
Okay.
So one of the challenges is how do I get my processes in place to accelerate a lot of that where it's sufficient enough to meet the accounting standards to make journal entries. So I have estimated taxes. If those of you that were in individuals, you know you don't get the individual tax returns are due April 15th as well. You also get a 6-month extension if you want it. Most individuals do not because most individuals dislike filing tax returns. The general public does. So they want to get it done, and I don't want it lingering out there. So they will get it done as soon as they get all their information in place, and probably before April 15th. And this year, you're probably going to see even more individuals file early because there's an opportunity for an increased tax refund, if you will. That was because, just as an aside, the One Big Beautiful Bill Act on the individual front made changes that were retroactive to January 1 of 2025. But the withholding tax tables that employers use to withhold from your periodic paychecks was not adjusted. So what has happened is most taxpayers have paid a little bit more in than historically. They will get that back with a slightly larger refund. And so I think that's been publicized enough out there that the general public knows, hey, I can get a bigger refund, I want to file early, get my money. Now, effectively made an interest-free loan to the government. Is what it is. Okay, so same thing happens here. Just like individuals, the government does not wait until the end of the year to collect their tax from you. It's affected via withholding taxes. So you're in the employer-employee setting, which is predominantly the case in the United States. The employer withholds a certain amount of your pay and remits that to the federal government on your behalf as your payment during the year. Okay, nothing. There is no. You don't have to do anything else as long as you have sufficient withholding taken out of your periodic paycheck. If you're self-employed, there is no employer to withhold from you. So we talked about in that course that you had prepayments or estimated tax payments. Same thing happens on the corporate side. The corporation itself, to satisfy its liability because it's a separate taxpayer, has to make estimated payments during the year. The government is not going to wait till April 15th or October 15th to collect their taxes. They need revenue now. So you have 4 quarterly estimated payments. They are due on the 15th day of the 4th month, the 6th month, the 9th month, and the 12th month. If you work in a corporate tax department, you will get to know those dates for your particular corporation, and there will be exercises trying to estimate your corporate taxes so you can make that payment. Okay? The idea is you want to get that as close as possible. You don't want to overpay. That's an interest-free loan to the government, just like individuals. You don't want to underpay because just like individuals, you can be subject to interest and penalties if you're vastly underpaid. Okay? The government has the power of the pen. They don't pay you interest, but they can charge you interest. So corporations are subject to underpayment penalties if they do not pay 25, 50, 75, and 100% of their required annual payment by the above due dates. Okay? The required annual payment of a corporation is the least of 100% of the prior year's tax liability. You can always pay 100% of last year. Now that doesn't mean that you won't owe interest, because if this year's much better from a results perspective than last year, you paid in the minimum, you haven't paid in what you owe for this year. Okay? So the government may charge interest on that, but you won't be subject to penalties. You could pay 100% of the current year's tax liability. So flip that on its head, if you had a banner year last year, this year not as good, you don't want to pay 100% of last year's tax liability. You're paying too much in, right? So try to hone in on 100% of this year's liability. Or 3, which is what most people use, most companies use, the annualized income method, 100% of the estimated current year's tax liability using this annualized method. So corporations have to make these periodic payments in. There is no withholding tax mechanism. There's no other way for the government to get money from corporations. They have to wire these funds in on a quarterly basis. The annualized income method, that third one, I want you to understand this. You don't need to be an expert in this. I just want you to understand if you walk into the doors of a corporation, you're probably going to run into this pretty darn quick. What are you guys doing? Oh, I'm working on my annualized income method, and I got a quarterly estimate coming up. Okay, now, flagging that to the treasury people, flagging that to your CFO, like, hey, this number's looking like it's going to be about like this. You're going to be ready to make a wire transfer by the 15th? Everybody's on board with that. You don't want to call up the morning of and say, hey, you got this big payment. So, under the annualized income method, you measure your taxable income as of the end of each quarter, and they annualize or project the amount to calculate their estimated taxable income and tax liability for the year. So you see lots of estimates here. Why? Because you haven't done your tax return. You don't do your tax return for months and months. So this is not even after December 31st, where you have till October 15th. You're within the year. You're making estimates of what your taxable income is. So how are you doing that? That's those book tax difference, that middle column. You're going to have your financial statement numbers, right? Because they're going to give you a quarter in number. You've got to be ready to roll with what do I think my book tax differences are, so I can estimate my taxable income for that quarter. That's why you got to have this inventory of book tax differences ready to go. What I have seen many times in large organizations, that column that had all those book tax differences, those will be broken up into individual people. Like they're in charge of these few accounts, these are in charge of these few accounts, and that's just your responsibility. That if there's any question about bad debts, they come to you because you're the one who tracks all that stuff. And that's not the only thing you do, it's just that's your responsibility. So that all this stuff doesn't fall on one person. Okay. Then you use that estimated annual tax liability at the end of each quarter to calculate the minimum required estimated payment for that quarter. So you use TI for the first quarter to project annual tax liability for the first and second quarter estimated tax payments. So you take that first quarter estimated TI and you'll use that number for first quarter and second quarter estimated tax payments. You use TI at the end of the second quarter to calculate your third quarter estimated payments. And you use TI at the end of the third to calculate your fourth quarter. So the only trick here is that first one you get to double up on your first quarter TI and computing first and second quarter estimated tax. Okay, let's start this example here. So 521 is Edmund.
According to the last page, we just talked about that for TI for the first and second quarter, we'll use the same thing. And then TI for the third quarter, we'll use the second quarter, and then TI for the fourth quarter, we'll use the second quarter. So looking at least, our first quarter is $1 million, so that will be used in first quarter and second quarter TI. And then we time, like the previous slide said, that we use this TI times annualization factor. So for the first and second quarter, we will both use the first quarter annualization factor, which is 4. So we should get like first quarter and second quarter the same amount of $1 million. And then going to the third quarter, we are going to use the second quarter. So now TI is 3.2 million. And then we'll use the factor of the second quarter, which is 12 divided by 6 equals to 2. So this should give us 6.4 million. And then similarly for the last fourth quarter, we'll use the TI from the third quarter, and that is 5 million. And then we will times the annualization factor of 12 divided by 9, that's 1.3.
Yeah, so these numbers here are the last column on that spreadsheet that we were talking about. So you've got the book numbers, you rolled through what you think are your book tax differences, and you got to these numbers at the end of those quarters. And those numbers come down here, and as Eugene's saying, you use the first quarter for the first and second quarter estimate payments, and then you got to annualize those. So those are saying, if I made $1 million in my first quarter, and I annualize that, I'm going to expect to make $4 million for the year. Right? That makes sense. But apparently in this example, the company started doing better throughout the year. So you saw that number kind of rise throughout the year. And we'll see as we carry this forward in the next example, I made incrementally higher estimated payments throughout the year to try to do that. But the key is I got to quickly take book numbers to taxable income numbers. Okay, 522 is Eugene.
Yeah, so based off of the previous example, we want to find what PCC required estimated tax payments for the year under the annual estimate are. And I guess we kind of start off by using the results from the last example. So when you look at the annual estimated taxable income, the first quarter, second quarter, all the way to the fourth quarter are the same as the annual estimated taxable income as we found in the last example. And then we want to multiply that by the corporate tax rate to find the tax on estimated taxable income. And you get the number that you see respectively. And then you want to take the percentage of the tax required to be paid, depending on which quarter it's from. So it's 25%, 50%, 75%, 100% respectively. And then you multiply the tax on estimated taxable income by the percentage of tax required to be paid to get our required cumulative payment. $210,000, $420,000, $1,008,000, and also $1,400,000.
So let me pause you there. So the first quarter, I estimate that my annual taxable income will be $4 million. We know the tax rate is 21, so it's $840,000. I don't have to pay all that in the first quarter, right? The government just wants it started. I pay a quarter of that in the first quarter, so that's 25% of that. So you owe me $210,000, right? So I'm not going to wait till the end to get my money. And then you just keep rolling that forward as I get better number. And this column 3 here is just, I ultimately have to get to 100% of that, but I just do it in stages. And I end up with $1,004,000, which is my most refined number because I have the best book numbers and I have my full year of book tax differences. So I think I'm going to have $6,666,000 of taxable income. 100% of that is due. So whatever I haven't already paid in, I got to make up the difference in my fourth quarter estimate. But I ultimately get to $1,004,000. Right now, that's my estimate. I didn't actually do a tax return that puts to $6.66 million. Right? I'm doing this in the fourth quarter of 25. And I just said earlier, I'm going to do my tax return on those numbers by October 15th. So there could be a lot of changes in that number. Right, people get anxious in this area because I estimated this, I told everybody. The treasurer and the C-suite think, well, I already paid that, I paid $1,004,000. You come in and you say, now I owe $1,005,000, they'll be like, what happened? Right? And they also don't want to have overpaid become the opposite because they do understand that they make interest on that. Okay, so that was book tax differences. You just got to go through each one of them. Remember, methodical. What's the amount? Is it permanent or temporary? Will it ever equal? Is it favorable or unfavorable? And that favorability is tax add-on. It's only favorable if I'm reducing my tax. It's only unfavorable if I'm increasing my tax, all relative to book income. And a few matters on corporate tax. I do want to just introduce chapter 6. Yes, ma'am.
Oh, well, I just had a couple of questions about the test, but,
Yeah, go ahead.
so how will we know exactly which tables you're gonna provide for us, like,
You're going to get the depreciation tables. That's the only thing I'm giving you.
just the depreciation
Yeah.
tables? Okay, and like, that's whatever's like included in the textbook, like those?
Yes, it'll look exactly.
Okay.
Yeah.
And then,
So if you think you need any other numbers, that's worthy of putting on your
sure,
sheet.
okay, and then, Can we just expect that the questions are similar to how they are in the textbook and like the problems we do? Okay, okay, just like work on those. You said 2/3 of it was like multiple choice and the rest would be like short answer, like writing it out, like.
Yeah, and there I'll just ask you to frame your thoughts and please don't go down the margin and on the other side of the page. I wanted you to clarify your thoughts in that.
Okay, and like any other advice for studying? Should we just do those practice problems that we have in the
Do the
textbook?
practice problems, slides, that's gonna be the stuff. Try to think through the rule, don't just try to write down everything from every slide.
Are the multiple choice questions also like based on like similar structure to
Yeah.
the textbook problems? They're just, you don't
So like I could ask you that same question on the, I think the NOL was 24,000 favorable temporary difference. I could say, give you those same facts and then say, what's the result? And I could have 24,000 unfavorable permanent difference, 24,000 unfavorable temporary difference. You just have to pick the one. So there's lots of different ways I can do that. It's just, instead of doing it all short answer, there's some will be formed in that. But it'll be the same, if you understand the examples, you'll be able to do exactly.
So is the whole test just numerical, or is there also like content-based questions?
There's concept questions. I'll just want you to see if you understand the concept and can verbalize the concept of it. Yes, sir.
Do you have any idea if there's gonna be any particular distribution? So is it gonna be like 20% chapters 1 to 5 or is it
So,
chapters?
I follow the BSBA grade distribution. And so I don't have that completely offhand, but it will be representative of the dispersion of the grades that the BSBA has articulated. The S&P program is doing something very similar, just hasn't been rolled out yet. That's the way I do it. So I will rank you all amongst yourselves, and then I will place you into those brackets that have been established by the university. So you're in effect competing against everything. Because I don't have any predisposed standard because I could have done a worse job teaching this semester than I did in the past. So it's just, there will be some of you that do really, really well. I promise you that. Because there's some people in here that are going to go into the tax field. So that's the challenge. Yeah, but that doesn't mean all the A's go to the tax people. That's not the case. A's is a pretty broad category. That's a lot of students. But,
Get out of this class.
you just have to remember that that's the case. You're in the tax major. I appreciate that not everybody's going into tax, but there are some people going into tax.
I thought the question was about like, is there going to be a greater weight on the exam on a particular section? Like, is chapter 5 going to have?
Sorry if I missed that. No, so I do multiple choice is 1 point per, and then I give 3 points for each short answer. And the reason I do that is because I get partial credit in the short answer. So there'll be, like if I ask you, explain this book tax difference, it might be, did they get the number right? Did they get the temporary versus permanent right? Did they get the favorable or unfavorable right? And that's the 3 ways. So, and I can't do that for multiple choice. And plus multiple choice has the randomness of you could circle and maybe get it right.
But like the content is like it's equal among all the chapters, or is there like a heavy?
Yes,
Okay.
sorry, yes, it will be throughout, steady. I take a sample of each. Okay. All right, so I just want to introduce this. This is not going to be on the midterm. It will be on the final. It will be covered. We'll dive into this on Monday as well, but this is just setting the stage for everything we just learned in chapter 5. So we're going to start here on chapter 6, and we're going to spend several class sessions on this. But this is the tax provision process. So the practitioners in this area and the people closely surrounding it will understand when this is happening, because again, it's a high stress area, it's a compressed time period. But this is the journal entries that go into the financial statement. People call that the tax provision because they are providing for the tax expense in the financial statements. That's why people call it tax provision It's also tax accounting, right? It's the bridge between the two, because now we're talking about the tax knowledge, and I have to get those numbers in the financial statement. So it is, if you have any thoughts in your mind, it's just tax expense, I debit tax expense, credit tax payable, a lot more complicated. Okay? And that's because we have these timing differences. And accounting wants to take account of the timing differences in the current year. That's what causes all the complexity. Okay? So we are going to spend our time in this chapter through 5 steps. And I pride myself on my slide decks. I will tell you, this is a slide deck. If you think you're going to go into this area, you can use this when you get lost. Because when you step on a moving train, as somebody's, a corporation or a client is working on a tax provision, there's going to be a lot of stuff going on. People are going to be running around doing a lot of things. You might sit in on a meeting and be like, I have no idea what we just talked about. I tried to work on this over the years, where this could provide you a nice roadmap that would be material for you. This is not stuff that changes. So unlike the depreciation rules, the NOL rules, where the government's in there tweaking it, they don't change the way they around the edges, right? There was some recent pronunciations on the accounting side, pronouncements about disclosures around the income tax footnote, and those type of things. So it's more on the fringes, but the core of taking the tax results and inserting them into the financial statements via journal entry hasn't changed. So that's what allows this to kind of be more of a permanent kind of helpful thing. So we're going to talk about step 1, identify all the permanent and temporary book tax differences and tax carry forward amounts in order to calculate the current tax provision. The current tax provision is what you expect to be on that tax return from what you're going to pay. Okay? So you're estimating this as to what you're going to pay in the future. But you're doing this in January. You haven't done that tax return for many months. So that's why you're compressing all this time. But that step 1 is, I always think about, I'm just trying to project what my tax return is going to be. That's my current tax provision. What is that tax return for that particular year? And then we're going to go step 2, which is balance sheet items. I have deferred tax assets, deferred tax liabilities. These are because of my temporary differences. That things are going to change over time. Depreciation, the classic one. Again, different carrying balances for tax purposes of tax basis versus book basis, because I do different things with depreciation. One's straight line, one's accelerated. That is causing deferred tax assets and deferred tax liabilities, not just in depreciation, other things. Step 3 is the deferred tax provision and the total tax provision. The deferred tax provision is the tax effect of those items that are going to reverse in the future, because ultimately they're going to equal. Temporary items ultimately equal at the end. They just get there in different ways. If I sum number 1, which is my current provision, I take into account number 3, all my deferred items. That's my deferred provision. That's going to get my total tax provision. That's my tax expense, my total tax expense. Because I'm not just doing my current tax return, I have to account for these deferred items. In step 4, we're going to do valuation allowance. That relates to my deferred tax assets, meaning that I don't carry assets as a general matter on the balance sheet in excess of their fair market value. I can't do that for deferred tax assets as well. We'll talk about valuation allowance. And then I have uncertain tax benefit reserves, which are positions I've taken on my tax return, and I may have some reservations about whether I'm ultimately going to win on audit or in court. Okay, so I have to assess that as well. And then financial statement disclosures. I have to do lots of footnote work around this as well. So we're just going to steadily march through this. It's one of those areas where you get lost in these things, but I think if you stay on these 5-step process, you'll be well positioned. Okay, so most income and expense items are included in both financial statement income and taxable income. However, oftentimes, as we've talked about, timing of the inclusion is not the same. These give rise to the temporary differences. Either the income goes in different or the expense comes in different between book and tax. Okay? Some items are included in one, but never in the other. Those are our permanent items. Right? So we're going to build on what we talked about in or in chapter 5. But we're going to bifurcate our temporary and our permanent differences. And you must consider your temporary and permanent differences in computing its income tax expense or benefit in its income statement and its deferred income taxes payable on its balance sheet. We're going to account for those current items, and we're going to also deal with deferred items. Okay? Lots of terminology here. I'm going to try to demystify that. We are going to be applying ASC 740. This is the accounting standard. It's income taxes. Accounting standards, codification topic, 740, ASC 740. You might hear some older people in the tax department or some older clients talk about FAS 109. That was the old US standard that dealt with the same topics. That was the accounting for income taxes. It just all got combined into ASC 740. So technically, that's where you find this. If you work for the Big Four accounting firms, or you work for a corporation that has an auditor at a Big Four accounting firm, they have really nice practice guides that you can just ask for. They're like textbook. And you can search through what your topic is, and it'll talk to you in plain English as opposed to reading the accounting standard. You can read the accounting standard and go straight to the source, more power to you. But sometimes these are a little more softer. And they certainly should be consistent with what that firm thinks that standard says. Right? They're not going to put out a guide that's inconsistent with what their firm's position is. So those are just really nice documents as well. So it contains the majority of the accounting and reporting guidance related to income taxes. However, just so you know, if you're in some specialty thing, investments under the equity method, stock compensation, business combinations, foreign currency, industry-specific areas like real estate or entertainment or oil and gas, they might be in an ASC that's specific to that particular topic. The accounting on the income tax results might be covered in those specific areas. Okay, that's again where the guide might help you. Importantly, ASC only applies to income taxes. That's all we're talking about here. Not sales taxes, not VAT, not anything else. It's income taxes, and it's the federal income tax, the state income tax, and the local income tax in the non-US tax jurisdictions. Okay? Think about a large multinational. Okay? You're in 50 different countries. You pay income tax in all those countries. You make money. You pay income tax in those countries. Think about what January looks like. I need to pull together the current provision and the deferred provision for all of that. This is busy season. You can just think of the amount of effort that all has to coincide really quickly to have journal entries, right? Everybody's got to be on board with that around the world that's helping you with the accounting and the tax computation. The income tax is based on income. It excludes property taxes, excise taxes, tariffs, sales taxes, VAT. None of that stuff is what we're talking about. We're talking about income taxes, which is income, or gross income, and less expenses times the income tax rate. All of those other items are above the line expenses. They're treated like business expenses, even though they might have the word tax in them. Right? You hear VAT, that's like it's an above the line deduction because it's not in tax expense. So we're only dealing with income tax. A company's failure. Our last slide. Our company's failure to accurately compute its income tax provision and related balance sheets accounts can lead to the issuance of material weakness statement by the company's financial statement auditor, and in some cases, a restatement of prior financial statements. This area is historically at the top of the list for errors in financial accounting. Why? Just because of what we just said, compressed timeline. And the interdisciplinary aspects of you have accounting and you have tax and you have it for large organization around the world. That's a lot to do in a pretty short order. You start requiring human beings to do a lot of things in short order, mistakes happen, right? And so that's why these people that are in this area, I put down here in the green, put it in green because I'm talking dollars in terms of compensation. People who can do this are handsomely rewarded in the corporate world and in the accounting firms that either audit this stuff or help companies be compliant with this stuff. And it's never going to go away. I don't think the time crunch is ever going to, because accounting is moving at a different rate than tax does. And the complexity, the changes we talked about with the One Big Beautiful Bill Act, the complexity is not going to change. So this is an area that is going to be around for a while. Just in that Texas in the Real World article, accounting for income taxes is complex and requires a deep understanding of both financial reporting and tax issues. Look at some of these stats. CFOs are 128% more likely to turn over, that means lose their job, like one CFO is replaced by another one, when a restatement relates to accounting for income taxes than for other areas of accounting. CEOs are around 55% more likely to turn over for tax-related restatements. So CFOs and CEOs are not tax experts, but they know this. So what do? They hire highly specialized people to help them not have these issues. I don't want to get in trouble with the board. I don't want the shareholders upset when a financial statement gets restated. Decisions were made on the old financial statements. You restate financial statements, that's when lawsuits fly around and people lose jobs. So not trying to scare anybody here. I'm trying to just say this is an area that is very, very valued in corporate America and in the accounting firm. Okay, so that's where we're going to head on Wednesday is start going through step one of that calculation. And if you have any questions as you're preparing for the midterm, just shoot me an email and we'll knock it out an email or something.
I need to get out. I'm gonna nap my I want to just like.
I know you.
You have the sunshine. I got wires and I want
Silly 7. Doesn't matter.
I know, I just feel like I shouldn't even on 9. Even though like I've done one chapter, which is taken up like a third of the page. No, I'm saying like a third of the front side. So like chapter 2 or like the page.
I don't know. I'm gonna first start with writing it all out.
3, 4, 5 on the back.
Today's like my writing day.
I'm gonna do like a whole page. Yeah. I'm just gonna have super small writing like I always do. I mean, it works for me. Usually,
This is like the only thing that like I'm
oh, I don't care. Like I feel like for me, it's trying to get as much done now than the night before. There's anything I haven't finished, just grinding through. Yeah. But.
The CPAs around me need help.
What makes me decide the
What makes me help? They told me, thank goodness. Are you serious? Oh, are you doing alright? Are you warm? I feel like it's so cold. My cold, like actually, I can't do this anymore. It is so warm. For a couple days. I know, but I feel 哦，你也知道。
我一次秒。
哦，是哦，
你可以告我说我3.5倍的套房。
我都买了。
哦，这个没有，但我是最后那个，我算的不是很对，但是 it's OK。我强行说自己这个好。
是的，那个就是把它。
我教了一点。
然后我们来另外一个。
我感觉这个老师应该挺酷的，反正咱们体育课讲，我一会儿再给你。
我今天说我室友没有生那么大胸口。他被我相当于被我签证了。
所以他要等这活到了1过才能回来。对呀，估计还要混几年，我感觉。
他最快也得混当时1周。哦，最快也1年。
Hi, Professor.
Yes.
Just a quick question. For the consolidated tax return, what about the M1 and the M2 form? Just need to do it.
Yes.
The food tax.
Yes, and so the M2, I have to, is that like reaching your earnings? Yeah, yeah. Yeah, so the M1 and the M3 also, yeah, so I think M2 is taking retained earnings and rolling it forward.
Oh, okay.
But the M1 and the M3 are just making them provide me the roadmap, the government, provide me the roadmap of taking from book income to tax.
How would that look like? Because they have to do it by or like.
You're starting to grasp the complexity of what's going on.
Yeah.
So none of this stuff is easy. It's like really easy to put on a slide or say this or that. But when you think about practically how that is, when some of these things have hundreds of subsidiaries, you just got to have processes in place to be ready for this, right? You can't be like starting from scratch because there's going to be not enough time. So the good thing is, you know, this has been going on for a period of time. So there are processes in place. They just move quickly. From closing of financial statements, because everybody, the tax people are saying, close the financial statements, close the financial statements. It takes its own time. They're trying to do their thing. But then when you get those numbers, then you have to jump in really quick and do all your book tax differences and get to that. And like you're saying, if I'm doing it on a consolidated return basis, I have to do those M1s on my consolidated return basis. It's a lot.
Now that I think of it.
This is job security.
Yeah.
It's job security. That's what it is.
Yeah.
You bet.
Have a good day.
You too.